If you've recently heard about the Fed dropping interest rates by 0.5%, then you may be someone looking to jump back into the housing market, whether for your first home or an upgrade. In this video, we're going to break down the 12 most frequently asked questions about home buying so you can go into the process with eyes wide open. I'm Elias, and this is Beth. Let's jump right in.
Question number 1. How much house can I afford based on my income? Well, when you're looking for a home, you need a ballpark estimate of how much house you can afford. Here's a few quick tips on how to do that. A good rule of thumb is to keep your mortgage payment to around 28 to 36% of your monthly income and your overall debt, which includes the mortgage you're about to get. So here's two big numbers to look at to calculate this. Your pre-tax monthly income, that's right, pre-tax, not post-tax, and second, your overall monthly debt payments, including what you would pay on a mortgage. Lenders will look at your debt to income ratio, which you'll hear called DTI, which is easily calculated by taking that overall monthly debt payment divided by your monthly pre-tax income times 100. It's also crucial to factor in property taxes and insurance to that monthly number. If you don't want to deal with that math yourself, and I sure don't, just go talk to a lender and get pre-approved. They'll walk you through this all step by step. If you're in the Dallas area, reach out to us and we'll get you connected with one of our very trusted lenders. Our contact info is in the description below.
Question number 2. How much do I need for a down payment on a home? Well, great question. Traditionally, a 20% down payment is a recommendation that has been given. But many first-time home buyers are putting down 3% to 5% thanks to various loan programs. With a smaller down payment, you may need to pay private mortgage insurance or PMI, which is roughly $100 to $200 per month on top of your mortgage. But that's the trade-off to get into your home sooner. Also, expect to save up roughly 2% for closing costs. So therefore, our recommendation for first-time home buyers is save up 5% of the home price or 7% if it's not your first home purchase, but still the home you want to live in. So what does that look like? For a $300,000 home, 5% is $15,000 and 7% is $21,000. For a $400,000 home, 5% is $20,000 and 7% is $28,000. And for a $500,000 home, 5% is $25,000 and 7% is $35,000. However, we only recommended a lower down payment if you meet the following criteria. First, your debt to income ratio is healthy and you have secure jobs and you don't anticipate taking on more debt anytime soon. Second, you're in a growing city like Dallas or Tampa. This will make it a financially smart decision because what you lose in PMI and interest payments, you'll make back from the home appreciating in value. If you don't want to deal with all this math yourself, we recommend you simply speak with a lender and get pre-approved.
Question number 3. What credit score do I need to buy a house? Most conventional lenders require a score of 620 or higher, but FHA loans can go as low as 580. Another good rule of thumb is score of 700 or higher gets you the best interest rates available in the current market. Here are 3 primary ways to improve your credit that are immediately within your control. Pay off all types of debt you can, but especially credit card debt. Make sure those balances hit 0 every month. Second, raise your credit limit, but don't do it in a way that would put you in a financial bind later. The key is to raise your credit limit without using it, because that tells lenders you're responsible with your credit. Last, dispute any credit report errors that might be negatively affecting your credit. Other than the immediately correctable areas, also make sure to consistently make payments on time. Keep old accounts open if possible, and to be frank, keep making more money at your day job. Sometimes there's a quick fix to issues like low credit scores, but often it just takes discipline over long periods of time.
Question 4. What loan program is best for me? Well, there are a few major loan programs to help you think through them. Conventional loans are the most popular for those with good credit and a solid down payment. Within the conventional loan framework, there are first-time homebuyer programs that allow you to put 3 to 5% down, making it really nice for people who have good incomes and credit scores, but not much saved up. FHA loans are also popular since they help first-time homebuyers who have a lower down payment, lower income, and lower credit scores, but like with a first-time homebuyer program for conventional loans, it comes at the cost of a higher interest rate and private mortgage insurance. If you're a veteran, a VA loan is going to be your best product. USDA loans are perfect for rural homebuyers with no down payment. Find out which program matches your financial situation and goals. For investors, DSCR loans are getting popular again. For many of these loan products, you'll also want to consider whether you want a 30-year or a 15-year mortgage. The 15-year mortgage will have a lower interest rate, but a higher monthly payment, making it feel less affordable. The 30-year mortgage will be more affordable monthly, but it will cost you more in the interest over the life of the loan. As far as fixed rates versus adjustable rates, our advice is to simply avoid adjustable rates at all costs. An adjustable rate on your home that you live in is a gamble, and you don't want to deal with that. But hey, if you don't want to deal with this at all, just talk to a lender and they'll advise you based on your current financial situation. They'll walk you through all of this step by step, giving you all the options for you to choose from.
All right, so the next question is, what are closing costs? Closing costs typically range from 2% to 5% of your loan amount, depending on the situation. In Dallas, we typically recommend a potential home buyer to save up 2% for closing costs unless they have extenuating circumstances. These closing costs cover lender fees, appraisals, and title insurance. These fees are due at the end of your home buying process and are essential to budget for. Just treat it like part of your down payment. However, it is important to note that sometimes you can roll these costs into your mortgage or negotiate with the sellers to cover a portion. Make sure you're aware of these costs up front and make sure your agent is keeping you thoroughly informed so there aren't any surprises in the home buying process.
Okay, question number 6. What's the difference between pre-qualified and pre-approved? Someone who is pre-qualified has a rough estimate of how much they can afford based on their financial information, but it's not a solid offer from the lender. Someone who is pre-approved, on the other hand, has been through a thorough process of checking their financials and has been given an official loan amount that they can afford. Sellers take pre-approval way more seriously because it shows you are ready to buy. When we represent buyers, we are often able to make the case to sellers that a pre-approval letter is as good as a cash offer. And that's how important we think it is for you to get pre-approved by a lender if you're looking for a home.
All right, question 7. How long does it take to buy a house? Well, the process can take anywhere from 15 to 60 days from the time your offer is accepted to closing on the property. But before that, finding the right home could take weeks or months depending on your search. Things like getting pre-approved, finding a real estate agent, and negotiating can speed things up for sure. Be patient and stay prepared. It'll be worth it in the end.
Question number 8. Fixed versus adjustable rate mortgages. What's the difference? Well, with a fixed rate mortgage, your interest rate stays the same for the entire life of your loan, making your payments stable and predictable. An adjustable rate mortgage, also known as an ARM, starts with a lower rate, but after a certain period of time, the rate can change based on the market. Fixed is great for long-term stability, while ARMs might benefit those planning to sell or refinance in a few years. We don't recommend you risk an adjustable rate unless you are an experienced real estate investor.
Question 9. What's included in my monthly mortgage payment? Well, first and most well known are principal and interest payments. A principal payment is the money that goes directly toward a repayment of the original amount of the money borrowed in a loan. So if an original loan was for $400,000 and you've paid off $100,000 of principal, that means you now have $300,000 of principal left to pay off. Interest, on the other hand, is the money you pay that doesn't go towards the home. Paying interest is the price you pay for borrowing money from a bank. Besides these two, most payments also include property taxes, homeowners insurance, sometimes PMI, which is your private mortgage insurance, if you put down less than 20% for a down payment. Lenders will likely set up an escrow account. It's a type of a bank account specifically just for your mortgage to pay those for you, ensuring that your taxes and insurances are covered. Lenders will help you make sure you budget for all of these when planning your home purchase.
Question number 10. How much should I offer in a home? I love this question. Your agent will start by reviewing recent sale prices for similar homes in the area, known as comparables or comps. The next important thing in this question is finding out what the motivation of the seller is for moving. If the seller is wanting the max amount of money, or if they're trying to offload the home as fast as possible, or anything in between, then we have to recognize the market we are in and make offers based on the market. For example, if the market is hot, you may need to offer full price or higher. Things like cash offers and no contingencies can make your offer even more attractive in these hotter markets. In a slower market, you might have room to negotiate the price. You may even be able to ask the sellers to pay for closing costs or make seller concessions or significantly decrease the list price depending upon the state of the market and their motivation. There are other ways to write offers and negotiate strong offers without adjusting the price of the home. These other methods can include, but are not limited to, who is paying for a home warranty, who's paying for the title work to be done, who is paying for a survey, how much is the buyer contributing to an HOA transfer, and many other little ways to increase the seller's interest in accepting your offer over another person's offer. A brief testimonial, I've had a seller accept my buyer's offer, which was $40,000 under the next higher offer due to a strategic offer being written up.
All right, question 11, how can I make my offer stand out? Well, getting pre-approved is the first and easiest way to do that. A pre-approval letter is almost as good as a cash offer because it shows that you are serious and are able to afford the home you're wanting. Offer a higher amount for option money with fewer days and more earnest money if you want to show the seller that it's very unlikely that you're going to back out after they accept your offer. Also, be flexible with your closing timeline. Every seller has a unique life situation too, so if you can be flexible, people will want to work with you. And if you're in a competitive market, consider waiving contingencies, but be very careful with those. Make sure you're in the right financial and life situation to back whatever offers you're making. And of course, cash offers are always music to a seller's ears. A strong, clean offer can make all the difference in landing your dream home.
That's right. So question 12, should I get a home inspection? 100% yes. A home inspection gives you a clear picture of the home's condition, identifying any potential issues before you close the deal. Even if the house looks perfect, an inspection can uncover many things like plumbing issues, roof damage, a faulty wiring, or many other things. It's an investment that can save you from unexpected repairs down the road. Not to mention, a home inspection will give you a lot of leverage to negotiate the price of the home. Always inspect before you commit. Even on a brand new home, I always recommend a home inspection. Inspectors typically will find pages of things for the builders to fix or even repair on brand new homes. As always, thank you for watching this. If you found any value in this or have other topics you want us to cover, please reach out and put it in the comments below. Our information is in the descriptions below. We look forward to seeing you next time.